Hello, everyone. Clint Lee here, research analyst for the Bauman Letter, along with Ted Bauman, editor of the Bauman Letter, with your next edition of Your Money Matters. It's good to see you, Ted. First question I want to ask is, I know you were having some back pain earlier in the week. How are you feeling today?
Oh, I'm feeling a lot better, Clint. Thank you very much. It's just that because I've been staying home, I've been exerting myself on all these household chores and things that have been piling up, and I probably overdid it, but much better, thank you.
Good to hear you're doing better. We kind of same thing going on around our house, taking advantage of the extra time home to do various home improvement projects, I guess, as it were. But speaking of improvements, we've seen an incredible rally unfold here in the markets. The S&P 500 just this week alone up 12%. Now, it's Friday as we're recording this, and the markets are closed for the Good Friday holiday. So in only 4 days this week, S&P has been able to manage a 12% gain. That takes the 3-week total to about a 25% rally, which seems incredible because when I look at the headlines of the last 3 weeks, in the last 3 weeks, 17 million people have filed for unemployment benefits. And so I guess with that, I'll turn it over to you, Ted, to see what's your take. What's the driver behind this rally we've seen unfold?
Well, this is not the end of the crisis. I think, we need to be clear about that up front. This is by no means the end. This is, as I said in my Friday note, my video on Friday, I think we're headed for a W-shaped double bottom. But the important thing to understand here is that this rally is not based on a broad recovery across the market as a whole or the economy. And I think what we're seeing is the cumulative effect of decisions that have been made really over the last, going back 40, 50 years, about how the economy is structured, about how the financial system integrates with the economy. And we're now seeing this play out in real time in terms of the ways different sectors react to the stimulus that has been released, not just by Congress, but by the Fed. And to show that, I want to show one chart to start with. This shows the performance of the S&P 500 since March 23, when we saw this turnaround, compared to ETFs that cover the financial sector. That's XLF, which is up substantially more than the market as a whole. And then the REIT sector, VNQ, real estate investment trusts. Now, there's only one way I think that you can explain this, and that is to understand that the way that the current setup is in not just the government, but the institutions that are able to take advantage of the stimulus packages that are out on offer, particularly what the Feds are doing, those are the ones that are benefiting, right? And they are seeing tremendous gains that are lifting up the whole of the stock market. I want to show you a second chart now that shows the impact since the Fed announced an additional 2.3 billion stimulus targeting the market. And here you see the S&P 500 at the bottom. That's over the last 5 trading sessions. And above that, again, we see XLF and VNQ. And what we see, again, is just they are roaring away from the pack. Now, my take is that this is because of the way things are designed. Now, back in the 16th century, a very clever Frenchman named Richard Cantillon observed that the way that money flows through the economy is based on how close people are to the king. In this case, the king is Wall Street and the Fed. And essentially, I think what's happened is that the kind of money that is being made available to resuscitate the economy, the stuff that's getting out fastest is the Fed's stimulus. As we know, the Congress stimulus is still in a disaster situation. Money is not getting out. So what's happening is that we're seeing stocks that are related to the financial sector, where the Fed is saying, look, we'll cover your debts for the duration of the crisis. We'll even cover your junk bond debts. We'll cover you guys. Big banks, financial institutions, they can immediately take advantage of this. And investors don't even need to know that they have taken advantage. All they need to know is that that backstop is there and the stock prices go up. For everybody else, not so much.
What do you mean by junk bond debts? Are they expanding purchases to include even that low quality area?
Yes, absolutely. I mean, basically, the Fed has essentially, the regulations that I saw the other day said that the Fed was taking bonds and they were looking at them and saying, okay, we will take your ratings, the ratings of your bonds, your corporate bonds, as of, I think it was March 22nd. Everything after that, nothing matters. So there are companies out there whose credit ratings are in the really I want to say in the toilet, who are able to get Fed backstopping that they are only able to get because of the way these regulations were written. Now, an ordinary company like a restaurant down the road or a hardware store or any retail store, they're probably going to have to wait until July before they see any kind of business support from the government. So what we're seeing is exactly what Richard Cantillon talked about, that when money is made available to the economy, it flows to the path of least resistance, and that means Wall Street, and that does not mean a broad-based recovery. So that's what I'm concerned about, that we may be looking at a phantom recovery that is based simply on a set of stocks that can take advantage of the stimulus quickly.
So I know for many professional traders, for many professional investors, they'll have a set of rules that they abide by. And one of those rules that's almost always on that list, if not near the top of the list, at the top of the list, is don't fight the Fed. We see that a lot in the markets. You look at really at any point in the last decade, when the Fed's switched to an easy monetary policy stance where they're trying to stimulate the economy, whether it's QE or these other programs, we almost always see the stock market take off. I mean, even, last instance of this was fourth quarter of 2018. We had the big sell-off because the Fed was raising rates. But as soon as they pivoted, the market turned on a dime and never looked back. But I guess what I want to know is now they're starting to take these more targeted approaches. It seems to try to provide funds, maybe directly or indirectly, to Main Street. So how does their actions that has all these great implications or great impacts on the financial markets, how does that eventually make its way into the economy? What's that mean for Main Street?
Well, I think unfortunately it doesn't mean anything. I mean, when you are trying to release money through the banking system, and let's be clear, the Fed is going far beyond just easy money. The Fed is basically saying that they are going to be backstopping credit markets, which means that in addition to making money available into the financial system, they're basically saying, look, we will essentially cover your debts for the duration of the crisis, only for companies that can access these facilities, and that's not all of them. But the theory is that if the Fed does this, that these businesses will continue to operate as normal, which means that they will feel comfortable to go ahead and make purchases and do whatever business they were doing. But that's not necessarily the case. Once the Fed has backstopped the financial system, it's up to the financial system to decide whether it wants to lend money to Main Street. And under these circumstances, what we've seen is that even with the congressionally mandated loans that are supposed to go out through the Small Business Administration, they're not going out. And they're going out with all kinds of restrictions that the banks are putting on them because the banks are private businesses. And they're saying, look, hey, hey, Congress, we can't change the way we do business just to hand money out. Now, back in the New Deal, this would have been done directly through the government, and the government had systems set up to be able to reach people quickly. We're asking the Fed to do something it's not designed to do, and that is the problem. But I think this reflects something that really goes back to the nature of income distribution in this country. And I want to show you two charts. I know it sounds like it's tangential, but trust me, this goes to the core of the matter. The first chart, which comes from the New York Times, shows basically what has happened to the bottom 50% and the middle 40% of income earners in the United States as GDP has grown since 1980. Now, as you can see, incomes in this country have not kept up with the growth in GDP. Now, let's switch to a second chart that shows what's happened with the very wealthy. They have essentially captured almost all of the additional growth in GDP that didn't go to the 90% below them. Now, how does that fit this current situation? Well, the economy and the financial system has adapted to this situation. It has adapted to a situation where there's a lot of money at the top. So there are mechanisms in place institutionally to get money to those people because those are profitable. They've been cemented in place over the last 30 or 40 years. So it's very easy for money to flow from the Fed into those channels, which basically goes to people who already have what they need. Not so easy to get money to everybody else, and that's what worries me. That the current structure of the setup is just like Richard Cantillon said it would be. Basically, the people close to the king, the Fed, are doing fine. All the peasants out in the countryside, not so much.
So I want to go back to something you mentioned just a moment ago, because I've seen similar headlines that businesses, especially small and medium-sized businesses, are struggling to get access to the stimulus funds that have already been passed. And when I look at the scope and scale of this crisis that we're currently in, you can certainly draw parallels in terms of the depth of this downturn. We haven't seen anything like it since the financial crisis. You go back to the financial crisis, it took Main Street forever to recover from that event. You could argue that large portions of Main Street never did recover. Yet on Wall Street, for people who are fortunate enough to have the income and the savings to be able to invest in stocks, at the end of the financial crisis, the start of 2009 unleashed one of the greatest bull markets that we have ever seen, which only exacerbates that problem that you're highlighting just a moment ago. So are we starting to see that cycle repeat itself here again?
Well, absolutely. But I think this time it could be dramatically worse. I mean, last time we had a financial crisis and it affected a lot of businesses, but it didn't shut the entire economy down. What we're seeing right now is a scenario where if those stimulus programs cannot get their act together and get money out to people within the next 2 weeks, really, we could see huge chunks of the small business economy of the United States essentially cease to exist. Now, imagine what will happen once the general crisis is over and all this money that's out there, once it starts circulating again in a quote unquote normal economy. What's going to happen? Well, it's going to go straight back into the stock market. It's going to go straight back into the bond markets. We're going to see that bizarre scenario that we used to think was bizarre of stocks and bonds, both on bull runs at the same time. But we're going to see a Main Street, really almost a depressive economy. How are things going to catch up when these businesses have shut down? It takes years to restart an economy in those circumstances. So for me, we're headed to 2008 times 2 if we don't get the actual Main Street part of the stimulus going quickly. And I'm not the only one saying this. The incredible thing to me is even the Wall Street Journal, which is usually very pro-Wall Street, is saying, hey, folks, the way this is going right now, this is setting us up for a big, big problem.
So obviously a lot of people that are watching this right now want to know what they should be doing with their investments, how they should be positioning themselves with everything that's going on here. And for me, when I see that the market, that the S&P 500 is up 25% just in the last 3 weeks, you're commenting about all this stimulus coming from the Fed that's just making its way directly into the markets. What I think about is I should just own the market. What I should do is I should go out and I should buy a broad-based ETF because we're seeing this big melt up and just let it go. Do you agree with that?
No, I don't. And I think it's important to disaggregate the market based on what the analysis that I've just presented, that you have to look at how the stimulus money is flowing to different parts of the economy. And the money is going to the financial sector. Let's be clear about that. So right now, although we're seeing a broad-based improvement in stocks, it's partly because the way that the current stock market is structured with all the ETFs and passive funds, it lifts all boats, but they're not lifted equally. So my prediction is that you're going to see big gains in ETFs that cover the financial sector, like XLF, for example. You're going to see big gains that cover the real estate investment trust sector, VNQ, because those are both sectors that can absorb money quickly and can benefit from the Fed's backstopping immediately. But I think what we're going to see is that after we start to see some actual GDP figures, like, for example, when we see first quarter GDP and then second quarter GDP figures, people are going to go, oh my God, wow, this is actually a lot worse than we thought. So consumer stocks, all those other stocks that are going along for the ride right now are going to start to pull back. And I think that's where investors got to be careful. So my recommendation would be go along for the ride. Buy into the financial sector, buy into REITs. And just as a side note, we have REITs in our portfolio, but all of them would stand on their own 2 legs without this benefit. That's why we chose them that way. But there's a whole other class of REITs, particularly in the mortgage sector, that are just, their stock prices are going up 30, 40% over a couple of days just because of the Fed. So by all means, buy them now. But remember, eventually the shock is going to hit people. and they're going to get sold out again. So make sure that you are ready to sell when the time comes. And the third thing I would say is assume that we're headed for the post-2008 scenario all over again, but this time on steroids. We can see a devastated consumer economy after this crisis has abated, but again, the stock market's probably going to be very strong. So we're going to see very similar kinds of conditions to the ones we saw over the next 10 years. Now, whether the ordinary American has the ability to take advantage of that, it all depends on what happens with the stimulus program, how quickly it can get out to Main Street. So I'm concerned, sorry to be so negative, but I do think that the way things are going right now, if something isn't changed quickly, we could be headed for trouble.
Well, I know this has certainly been a difficult market to navigate, both with the declines that we've seen and then this incredible bounce back. That's why I'm excited. I know you're excited as well, Ted. We've put a lot of work into the next issue of the Bauman letter that'll be out this week. It's Monday as you're seeing this. We'll have our next issue out this week. It is a bear market survival guide. It covers a variety of areas. It doesn't matter your investment objective. It doesn't matter your risk tolerance. There are strategies in there for unique opportunities to pick up stocks in this environment, for protecting your assets, for generating income. So for all you Bauman Letter subscribers out there, be on the lookout for that. Our Bear Market Survival Guide will be out here soon. And if you are not a Bauman Letter subscriber already, just look at the link below this video and that will get you started. This is Clint Lee and Ted Bauman for Bauman Letter and Your Money Matters. Stay safe, stay healthy, and we'll talk to you again soon.